Don't you just love a good cliffhanger? In part 1 of this series, we have one of the simple investment instruments or asset classes as a primer to the more advanced and complex investment instruments that exist. Be sure to check it out in the menu bar somewhere on your screen. Now, if you had clicked your like, subscribe, and notification bells, you've been well aware of when this next video drops, so be sure to do that as well. But in this video, we're going to deep dive into some of the most complex investment instruments known to man. Get your thinking caps and slide rules out of the drawer. This one might be a little bit tough to digest. What's up, you guys? You're watching BTV Fusion. I'm your lovable, affable, handsome, bearded host, Derek West. It's a lot of adjectives, wouldn't you agree? If this is your first time here, welcome. If you're coming back, we're glad to have you. Let's dive right in, shall we? In the previous video, we went over some asset classes that we consider not so risky on the asset ladder. Things such as cash deposits in a savings or checking account, or a certificate of deposit. Bonds issued by corporations or government agencies. Stocks issued by corporations that either appreciate in value or pay dividends, possibly both. Mutual funds, a basket of stocks that's either actively managed or designed to track an index, i.e. an index fund. ETFs, which are similar to index mutual funds, except they're traded throughout the day, and thus can rise or lose value in response to trading volume throughout the day. Lastly, we went over Forex, which is essentially foreign currency exchange. Each of those are probably the simplest way that you can choose to invest your money, if you're into buying investment assets and not necessarily concrete assets like real estate, physical gold, or other commodities, or things such as franchises, for example. Each of those types of asset classes can be approached by everyone from the most novice of investor to intermediate and even experienced investors. Investors that are aware of the volatility of the markets where the assets are being traded, and possibly of loss that they represent. In other words, if you open up a brokerage account using Charles Schwab, or pick some other brokerage, owning and maintaining each of those investment types is as easy as opening up Facebook and liking and sharing a few posts. Keep in mind, and this is key, so stick with me, all investments have a risk of loss. You should not purchase investments without understanding what they are, or consulting with a certified financial planner, and do not listen to people on YouTube for investment advice, myself included. That said, there do exist extremely complex investment vehicles that even seasoned and savvy investors recommend you just stay away from. With that in mind, why would someone even think about a non-standard, complex investment vehicle? Well, there are several reasons an investor or portfolio manager is likely to consider adding alternative investments to someone's portfolio. In some cases, money generated from alternative investment might be subject to far more favorable tax treatment than that of a more traditional investment. As an example, if an investor or client has significant tax loss carry forwards or tax credits that can be applied to a particular type of activity or source of income. A common example we can think of is real estate, right? Real estate has several tax advantages. That's why a lot of people put their money in it. Sometimes the investor or his or her advisor have a deep knowledge or unique skill set in a specific area that can cause alternative investments to make sense. For example, if an experienced entrepreneur in the oil and gas industry had the resources and patience to take advantage of a major oil or gas glut, that unique knowledge and experience might pay off handsomely. In other situations, a particular alternative instrument or alternative asset class might emotionally and intellectually hold the attention of an investor more than other asset classes. Another example for you. There are successful investors who are deeply drawn to venture capital because they enjoy the process of identifying, funding, and taking ownership in startups and relatively new enterprises. There are some investors who just hate stocks and bonds. These are the folks that tend to keep the money out of the stock market and invest instead in real estate properties they've acquired and renovated. To some people, it just makes more sense. They feel that they've got a better understanding of the potential gains and losses, especially when compared to the daily volatility that is part and parcel of owning publicly traded common stock. Now, those are reasons why someone might want to own an alternative investment. There are several reasons to not want to own alternative investment types and asset classes, if you don't have specialized knowledge and skill. For the uninitiated, the complexity can mask hidden risk. Often when investing in things such as pooled structures, there can be a lack of transparency that makes it impossible to truly understand the risk you're taking. One real-world illustration. In the official government reports on the financial crisis of 2007 to 2009, the Commission found that certain funds sponsored by investment banks had engaged in what is often called window dressing, by selling risky assets and reducing debts prior to the end of a reporting period to make the funds look safe to the owners. These owners were given a false sense of comfort about what they owned and risks to which their capital was exposed. It's not unheard of for alternate investment classes to be wiped out in a total, complete loss for investors. You need to have a healthy fear when you're venturing into many of the investment classes that we're about to talk about. Your willingness to walk away from an investment you don't fully understand can lower your risks substantially, almost to zero as a matter of fact. Another reason to avoid alternative investment vehicles: wacky tax situations. If you're not careful, your investment could be putting you into an unwelcomed, tax-liable situation. Think about this. Consider you're investing in a private partnership. The partnership doesn't have a mandatory tax distribution clause, despite being structured for pass-through taxation. You could end up with a huge tax bill that you have to pay out of pocket, even if the partnership doesn't distribute any cash to you during that tax year. That might be fine if you have a ton of cash lying around, and you feel the investment still makes sense. It could create a real hardship if you had to sell other assets or borrow money to pay your bill to the IRS. So we know why someone might want to invest in non-standard investments. And we know some of the downsides and pitfalls. With that knowledge in mind, what are these instruments? Let's kick it off with collateral debt obligations. Speaking about complexity masking hidden risk. This asset class was at the heart of the financial crisis that kicked off the so-called Great Recession. A CDO is a security that consists of a bundle of individual loans and other debts that have been packaged together. They include debts with mixed creditworthiness, such as mortgages, car loan, credit card debt, and corporate debt. They're called collateralized because they're backed by some type of asset, collateral. When you buy a CDO, when you buy a collateralized debt obligation, or CDO, you take on the risk that the initial loan will not be repaid. A CDO is a type of derivative, where a derivative, another exotic financial instrument as a matter of fact, is a financial contract that receives its value from another asset, or it's derived, get it, from another asset. Other derivatives you may have heard of before include forwards, options, and futures contracts. Let's talk about forwards for a second here. A forward contract is an agreement between a buyer and a seller to trade an asset at a future date. The price of the asset is set when the contract is drawn up. Forward contracts have one settlement date. They all settle at the end of the contract. These contracts are private agreements between two parties, so they're not traded on an exchange. Because of the nature of the contract, they are not as rigid in their terms and conditions. Many hedge funds use forward contracts to cut down on the volatility of an asset's price, since the terms of the agreement are set when the contract is executed. A forward contract is not subject to price fluctuations. If two parties agree to the sale of 1,000 ears of corn at $1 each, for a total of $1,000, the terms cannot change, even if the price of corn goes down to 50 cents per ear. It also ensures that delivery of the asset, or if specified, cash settlement will usually take place. Let's talk about options. Options are contracts between two parties that give the buyer the option, get it? To buy or sell a particular asset at a set price, on or before a specified future date. The seller keeps the money paid for the option, even if the buyer doesn't exercise their rights. If you buy an option, but don't exercise your rights to buy or sell the asset by the due date, it expires and becomes worthless. Selling an option can be very risky, especially if you don't already own the underlying asset. If the market rises above the exercise price, you may be forced to buy at the market price and immediately sell at the lower exercise price, incurring an immediate loss. Next up, futures contracts. Futures are contracts to buy or sell a particular asset or cash equivalent at a specific price on a specific date in the future. For example, a company may use a futures contract to lock in on the price of a foreign currency. Futures are also widely used for speculative trading and also for commodities trading. A futures contract is legally binding, no matter what the market value of the asset is when the contract matures. This means either the buyer or the seller of a futures contract can potentially face high losses. As you might imagine, we are only just scratching the surface. There are other asset classes out there. And again, don't misconstrue this as investment advice. But if you don't understand any of these, I would stay away from them. When used with specific knowledge and expertise, they can be powerful, and they've made people into successful investors. But those people likely had deep expertise, or may have been in the right place at the right time. And with that, don't forget to click that like and subscribe button, and the notification bell in addition to that. We upload great videos on business, technology, and personal finance every week, and I know you don't want to miss it. So stay locked in, and we'll catch you next time.